What's up, guys? I'm here behind the scenes at a huge real estate and mindset conference with none other than Dolf de Roos. Dolf, thank you so much for doing this interview. Really appreciate it.
My pleasure, Jonathan. Always great to be with you.
Always a pleasure. And today, I'd love to ask you about what kind of returns you can expect from commercial real estate. Now, Some people, they get into the game and they say, oh, I do 12% on stocks every year. I do 25% on residential every year. They have these expected ROIs, these standards that they set for themselves. So when you look at a commercial property, what kinds of ROIs are you expecting to get?
Well, let me start by saying the industry standard right now is known as the cap rate when it comes to real estate. Cap rates are hovering around 6%. Now, in a good economy, cap rates tend to come down, and in a bad economy, cap rates tend to rise. It's a bit of an inverse law, so you've got to get your head around that. But right now, they're about 6%. Having said that, Jonathan, I'm not interested in buying a building with a 6% return because I think it's easy to beat the average in real estate. And one of the contentions I make is that unlike most other investment vehicles, where I haven't yet figured out a way of consistently beating the average in any economy, in any country, in any part of the economic cycle, when it comes to real estate, I believe I have 18 separate ways of beating the average. And so in beating the average, I want to get a return on investment, an ROI, that is better than the industry average. And there are several ways of doing that. There was a time when not many people were interested in commercial real estate, that I could just look for deals where the returns for me were 10% or 15%. I used to buy commercial deals at 20% return, and looking back, it was so phenomenal. Why didn't I get even less sleep and look at more deals? Because if I'd bought twice as many back then, theoretically it'd be twice as well off now.
And that was when interest rates were higher too, right?
Interest rates were higher. And everyone's up in arms about the fact that interest rates are really high right now. I don't mind so much. And I don't mind for specific reasons. And I know this is a tangent, but I think it's worthwhile going down this little rabbit hole for a while, Jonathan. Because everyone's saying, gosh, inflation's the highest it's been in 13 years, and interest rates are the highest they've been in 2 decades, or whatever the numbers are. And isn't it bad? And there's doom and gloom, and the economy is going to implode, and it's not just a recession, it's a depression, and everything's going to turn to custard. Mm-hmm. Well, even when we look at the so-called GFC, the global financial crisis, even when we look at that, prices came down a lot. I live in Phoenix, Arizona. Prices came down by 60%. I've got some properties that went down by 80%, which you think would be calamitous, and in a sense it was. But on the other hand, that's the prices that people were willing to pay for real estate. They came down. It didn't mean that I wasn't collecting rent. In fact, rents didn't come down by as nearly as much. Because in that case, 2008 GFC in Phoenix, at one stage there were 90,000 homes in foreclosure simultaneously. And that's terrible, of course, especially if you were one of the 90,000 families who had their homes going to foreclosure. However, those people, even if they lost their homes, they still lived somewhere. It's not as if they slept on park benches. So that means there was a very high demand for rental properties, and all my properties remained rented right throughout the GFC. The other reason why I'm not too concerned about high interest rates or this fear of an imploding economy is simply that when interest rates are high, people stop buying homes. So let's say in the United States, 10 million people who would have bought a home if interest rates had stayed low. Now with high interest rates, they can't afford to buy one, so they don't buy a home. That's 10 million homes that aren't being bought by owner occupants. That means there are technically and mathematically 10 million homes that now can be rented out to the same people that otherwise would have bought, which again means rents are staying high. In an odd sense, it benefits those who own real estate or who can figure out a way of buying it. And what I do really is for myself and for people I work with is figure out ways of buying real estate that still makes them lucrative. They still are cash flow positive for you. So that's why I'm not too concerned about interest rates being high or inflation kicking in. The point I wanted to make is that when inflation does kick in, most people lose. Because inflation isn't really the price of everything going up. A more accurate way of looking at it is that the value of money is coming down. So let's say for ease of mathematical calculations, and I had inflation as 10%. That means what you can buy today for $1 million, in a year's time, you'd have to have $1.1 million to buy those same things. Again, it's not that they've become more valuable, it's that the value of money has come down, so you now need 1.1 million units of currency. In our country, it's called dollars, to buy that. With any other investment other than real estate, inflation hurts you, because if you've got an investment that's earning you 9% per annum, and yet inflation's at 10%, then at the end of the year, you're worse off by 1%, because your increased value of your asset hasn't kept up with inflation. The one exception to that, the only group of people on this planet, in my view, who kind of benefit from high inflation are real estate investors. And the reason is quite simple, using the same numbers. If you bought a property for $1 million, but let's say you had it 100% financed, and I know some of you are saying you can't do that. On residential, you can only get 80% financing, and on commercial, it might only be 50 or 60. I'm not saying get a single mortgage for 100%. I'm saying maybe you get 80% from the bank and 20% as a seller carryback or vendor finance, or whatever you want to call it. Or you borrow 20% from your uncle, or you get a second mortgage or something. So let's say you borrow $1 million to own $1 million property. And inflation's the same, 10%. So at the end of the year, that property would be worth, or would cost, 1.1 million. Remember, it hasn't gone up in value. The value of money's gone down. But your mortgage that you took out, the $1 million, it stays at the same numerical 1 million units of currency. In that sense, it's become easier to pay off on that wedge between the mortgage, what you've borrowed, and the increasing value, in quotes, of your property. That 100,000, that's equity that you've built up. And even though the bank financed 100% of it, they don't get any of that increase in equity. And if you hold on to that building long enough and it doubles a few times and is now worth 10 million, even if you never paid off any of the mortgage interest only, which, by the way, is the best way to take on a mortgage, the mortgage would still only be $1 million. The value of the building is 10. You've got 9 million of equity that you've created out of nothing. And you might say, hang on a minute, Dolf, if the property's gone from 1 million to 10 million, then the value of money's come down by a factor of 10. So that $9 million in value that you've created in equity, in today's dollar terms, it's really only worth 900,000. And my answer to that is, so what? It's still $900,000 in today's value that you've created out of thin air. No other investment vehicle that I'm aware of does that for you, because remember, the value that is going up, the million to 10 million in this case, wasn't our capital. It was the bank's money. And we still only owe them $1 million, and now it's only worth 1/10 as much as it was when we got it. So that's why I always say, some people don't sleep well at night when they have too much debt. And while I have some empathy for that, my situation is that I don't sleep well at night when I have too little debt. Too little debt means my building's gone from 1 million in value, say, to 10 million after Lord knows how many years. And I've only got 10% borrowing on it. My loan to value ratios, I need to refinance and pull more money out. Because the money I borrow from the bank, it's not earned income. There's no income tax on it. It's not the sale of anything. There's no sales tax. There's no capital gains tax. There's no depreciation recapture tax. It is tax-free money that I can put in my pocket to do with as I see fit. I know some of you are saying, but 10 million in borrowings, that means you've got high interest payment. Yes, but I've got an asset worth a lot that's paying rental income that should cover that interest. By the way, if it doesn't cover it, you don't borrow it. But normally it does. So I've now got $10 million or whatever, an extra $9 million of tax-free money in my pocket to do with as I see fit. And my original asset, which went from 1 million to 10 million, it's still going up in value. So I know that's a long-winded answer to your question. But honestly, I'm not worried about inflation kicking in. So in that context, what sort of returns are we expecting? Typically, you get a 6% return on commercial buildings. It varies, of course, not over time, where, as I said, in an improving economy, cap rates come down, and in a degrading economy, cap rates go up. Mm-hmm. But it varies geographically. So one of the most prime pieces of real estate on this planet is Wall Street in New York. Cap rates there typically are 1.5% to 2%. They're extraordinarily low, which means people are willing to pay a very high price to buy that rental income stream. Whereas in the backwaters of nowhere, or some podunk city, or something that's not very popular, cap rates might be 20 or 25%, meaning an investor would want a 25% return to risk investing in such a lesser area. And that's okay. You can buy in either one. You've just got to know what you're dealing with. You've got to make sure that the interest rate you're paying makes it worthwhile. If you're paying 6% mortgage interest and you invest in Wall Street and you're only getting a 2% yield, Well, you could ask yourself, why would an investor only be willing to accept a 2% yield on Wall Street when mortgage interest is costing them 6%? And the answer, of course, and this is why cap rates are so low there, because the real estate is so valuable there that you know that in all probability, the capital value is going to go up at such a rate that it will compensate for the deficit between your low rental income and your high mortgage interest.
Right.
And so anyway, cap rates vary over time and they vary by geography. But on average, they're about 6%.
Gotcha.
I try and beat that average.
Right. And do you have like a standard when you go into a property, you say like, this property is vacant, I know I can do this amount of improvements and I know I can put a new tenant in and make this amount. Do you have a number that you like to hold to your gold standard for when you buy?
So it's a great question. And the truth is, I used to have a number like that. I used to like buying above 20% return. And I know listeners now might be saying, well, that is a bit crazy. Where would you find that? Are you fantasizing that this was a reality? We used to do it regularly. But things have changed because the market has become more fluid. There are more and more properties that you can watch on the internet, which means people from anywhere in the world can instantly see what's available anywhere else in the world as long as it's on the internet, right? That never used to be the case. So I've switched my focus a bit. The way I get around that now, and I've got to give a bit of background to it, is one of the fundamental differences between residential and commercial is that a residential property is usually valued or appraised based on comps. Comps is short for comparables. So to summarize it, a 3-bedroom, 2-bathroom home of a certain size, a certain age, a certain condition, a certain number of features, single story or double story, swimming pool or not, spa pool, but a certain house, if it's sold for $450,000, then chances are the house up the road or around the corner or down the street that's got almost exactly the same size, age, condition, number of floors, number of swimming pools or spa pools, it'll sell for about the same price. And there's very little difference in price whether that house is tenanted or vacant. You could almost argue that it's a little easier to sell if it's vacant, because now if the buyer is an owner-occupant, they can move in straight away, whereas if it's tenanted, it's got tenants in there, you might have to wait for the tenancy agreement to expire before you can move in. But essentially, the value of a residential house is based on comps. That contrasts with commercial real estate, where the value of commercial real estate is literally a multiple of its rental income. If you want to be technical or you're checking me, the value of commercial real estate is the rental income divided by the market cap rate, right? Cap rate is short for capitalization rate. It is the rate at which you capitalize the rental to arrive at the value. So it all makes sense when you see it in that light. So with a commercial building, the value of it is a multiple of its income. Therefore, if we can find a commercial building that's only half tenanted, and let's say it's generating $100,000 in rent a year, but it's half vacant, half tenanted, same thing. And we can find another tenant for that vacant space at another $100,000 a year, then by going from $100,000 a year to $200,000 a year, we've doubled the income and therefore we've doubled the value. And if we use this imaginary 10% cap rate, just because it's an easy number, originally at $100,000, it was worth $1 million. But now that we've doubled the rental to $200,000, it's worth $2 million. And when we go to the bank and we say, here's an appraisal for $200,000, we want a mortgage. And he says, well, we as a bank only lend 50% on a commercial property. We say, fine, because 50% of $2 million is $1 million, and that's the purchase price. So I've done this again and again and again. I discovered it with a funeral parlor out of all things, and it's not the most glamorous building that people think of. If I were to describe to you now what goes on inside a funeral parlor, you'd probably say, okay, we get it, that's enough. But it was empty. No one knew what to do with it. It had been vacant for 3 years. And all I did is phoned around until I found someone who wanted to operate there. I said, have a look at it. If you like it, I'll have a crack at buying the building. Did I risk that he would go and like it and buy the building? Yes, that was the risk. It's never happened because people who run funeral parlors in general don't want to own real estate, right? So he looked at it. He loved it. I said, okay, here's an agreement. If you're willing to sign this and I'm willing to have a crack at buying the building, you'll become my tenant. And he said, not so fast, Sonny Jim. I'll only do it if you give me a long-term lease. And that's good. So it's one of these things where everyone can win. The new tenant can win. And by the way, talking about tenants, they're not my adversaries. It's not, can I jack the rent up another $1 a foot to his detriment? My tenants are my clients. Without them, I don't have a business. So work with them. Make sure they're happy, and they'll kind of make sure inadvertently and unwittingly and unintentionally, they'll make sure that you're happy. So there are some of the things you've got to look for. You've got to increase the value of the rent.
Gotcha. So Dolph, what you're saying is that your standard is, I mean, and I guess it's not your standard, but that's infinite ROI because you put zero money down.
Correct.
So in reality, you're not looking for a percentage. You're not looking to get a return back on your money. You're looking to put no money down and see how much value you can create for the property.
Right. No, it's a good way of looking at it. And few people understand that. If you put no money into the deal, then any return you get, even $1 a year on a zero investment, is infinite.
That's awesome. Well, thank you so much for sharing a couple of your secrets with us today.
You're so welcome. A pleasure as always. Thanks, Jonathan.